Hello guys and welcome to another developer video. Today taking an in-depth look at KB Home, a home building company based in the United States in Detroit, Michigan. KB Home is priced at $63.9 with a market cap of 4.6 billion. Their trailing 12 months price to earnings is 8.1, 20% below their 10-year average of 10.1. Their price to cash flow is 14.9 and their forward dividend yield is 1.58%. The revenue has grown by a respectable 40.6% over the past 5 years. Their net income has increased by 119.3%, which is extremely good for such a low PE company. Their earnings per share has increased by 146.7% because of their 16.5% reduction in common shares outstanding, which is extremely good. Now, taking a closer look at the liquidity and solvency, we can see that it's really good since they don't have any interest payments. Their interest coverage ratio is zero. The quick ratio is 0.83, which is surprisingly good because basically 85% of their current assets is inventory. So you'd suppose that they had a lower quick ratio, but they actually have a okay one. The long-term debt ratio is 0.42 and the debt equity ratio is 0.42 as well. The cash from operations has increased by 341.1%. The cash from investing has increased by 45%. The cash from financing has increased by 90%. Their capex has decreased by 12.5%. Their free cash flow has grown by 398.5%. And now, taking a closer look at their financial ratios, we can see that their return on equity is 15.5%. The return on investments is zero because of their lack of debt. And the return on assets is 8%. The return on invested capital is 10.5%. Now, taking a closer look at their valuation, we can see that using the DCF valuation, we get a fair value of $76. Using 10, 10, and 12.5 multiples, we get a fair value of 61.95. And their analyst expectations is 80.31, giving us an intrinsic value using all of these averages of $72.76. And adding a 15% margin of safety, we get a buy price of $61.85, suggesting that stock at the current levels is trading very near to a good buy price. Now, my personal opinion is actually a very good company. They have a solid history of growth. They have a stable business model. Their balance sheet is perfect. They're doing buybacks. They're growing a very great rate. This is one of the companies which I would say is underrated or under the radar. And in my opinion, the investment thesis on such a company is mainly linked to the economy. Now, this is a great company all in all, but there is just one big problem. If, for example, it ever happens that there is a big financial crisis and home building slumps overnight, basically, then this company is not really that great. And why is that a problem? Well, because they are not necessarily a cyclical business in general. Their only cyclicality is the economy. So they're cyclical in the sense that they actually follow the economy. So the economy is their cyclical system. Other companies do badly during crises because they have, I don't know, 10% lower sales, 5% lower sales. But such a company with such high inventory has a much bigger problem in recessions because when recessions happen and let's say home building drops 30%, all of those billions that are in inventory become useless and the materials they use, the employees, they have to fire them. And it's much harder to get back to normal activity. So it costs them a lot to recover. So they suffer a lot from recessions. Now, this is a personal take, but I believe that if Trump actually goes through with the tariffs and actually increases defense budget to 5% of GDP, then the United States will have a huge problem with their deficit. It's already gigantic, but and they actually think that they can print their way out of anything. But let's be realistic a little bit. You're investing in a country which has half of its budget as a deficit. How is that even possible? And why it's related to housing? Well, I believe that housing right now in the United States is becoming too much of a speculative asset, and by making the money literally a joke, so we are printing a lot of it, and half of the budget is a deficit, so money equals nothing. All of these home prices will increase, and they're already increasing. And maybe you can build homes now in the future, but the thing is, there is a point where you can no longer grow build homes. So this company has been growing a lot, but the thing is, the market cannot grow 10 times in, I don't know, 20 years. This is not a business that can, realistically speaking, grow more than the S&P, and that's why they really have that low valuation. Their low multiple is only due to the fact that they suffer a lot in recessions, and also that the market is not really growing. So all that they are doing is actually just taking parts of the current. They're taking market share of the current markets, so they're not necessarily improving upon anything. Um, yeah, it's a great company, but as I've said, there are macro reasons not for you to invest in it. Um, As for specific problems with the company, I don't see any. I think the management is doing a great job. Congrats to them. I think this is actually a buy. If you are not sure yet, maybe wait until they're 10, 15% lower than my acceptable buy price. So if you use a 30% margin of safety, then I think that's actually a great buy. Of course, do your own due diligence first. Now, let me talk to you about our affiliate, Ticker Data. Ticker Data is a great tool. I use it all the time. You can check it out in the link below. They offer real-time financial data for your Excels, and they also offer great templates. So if you have a portfolio, you can track your companies, you can do DCF with the templates, you can see how much money you have in 30 years, your portfolio. Basically, there is a template to see how much you'll be earning from dividends in 30 years or 20 years from a portfolio. We can calculate your dividend growth rate, your capital appreciation, and so on and so forth. So it's a great tool. You can check it out in the comments below. Also, check out my investing blog in the link below and my link tree. Uh, yeah, this has been it for today. I hope I'll see you in the next video. Bye.